Risk and reward. Look, I'm often asked by people, look, it's all very well, Alpesh, getting a 20%, 40% per annum, picking stocks based on valuation growth, income, momentum, cash flow, Sortinos, alphas, all these other metrics that you're using, dividend yields, and then filtering. But I'm in a rush, Alpesh. And I say to people, look, if you're in a rush, you're taking more risk. The lower the timeline, the greater the risk. However, if you were to put a gun to my head and say to me, okay, what could potentially give greater reward, albeit that there's always greater risk that goes with greater reward, then if I really had to point to stuff, and I've got a gun to my head, I'd say, and I've said this before, with the usual risk warnings, risk capital only, it is risky, it is high risk. 3 times leverage S&P 500. Why? Well, if the S&P over the next 12 months rises, you'll get 3 times the return. Okay, these are exchange traded products, but because they're daily leveraged, it isn't as simple as looking at the end of the 12 months and saying, oh, S&P went up 15%, I've got a 45% return, because it depends how it went there. If it went in a straight line, that would be fine. If it went up, down, up, down, up, down, up, down, the way daily leverage works, it would not give you the same leverage as 3 times. It's a perverse mathematics. Have a look at my great investments program to understand more. Or for instance, 3 times Nasdaq. Nasdaq's at an all-time high. Yes, on both of these I have made triple-digit gains, over 100% gains, but I appreciated the risk and it was suitable to my risk profile. Risk. Okay. Or again, 2 times leverage, Apple, Amazon, Microsoft. Why did I pick those and not other things? Well, because I think the underlying stocks are possibly some of the safest stocks for equities in the world. So if I'm adding leverage, I'm adding risk to some degree of safety. The major problem most people have with any of this is that they'll panic at the first sign of a move down. I remember 2 times leverage could see you suffer a lot of pain very quickly. The other way is smaller cap stocks, but with same high ratings, with value growth, income, cash flow, all the things that I look for, Sortino, Alpha, and so on. Those are the 3 major ways, okay, to get that, the number that sometimes people say, oh, 40% in 12 months or whatever. These are the major ways, but please be aware of the risks involved. Now, even riskier than all of this, which I'm not going to go into, is if you did a spread bet. The fact of the matter is most people will mess that up. They might put £10,000 into an account, buy some Amazon stock at a leverage of 20 to 1, so basically controlling £200,000. And if it went up 10%, they'd make £20,000, so that 10,000 has become 20,000. They made 100% return on their money. The problem isn't that. The problem is if it goes down, they'll get margin calls, they'll get wiped out. And trying to get that leverage and avoid the margin calls if the market drops, that's tricky. It's not something which is appropriate for a 12-month investment program like this, though it might be something that I cover going forward. It really is adding a lot more risk to things than I'd be comfortable just discussing in these simpler terms. Okay, so be careful. For instance, with spread bets, for instance, or CFD trades, I actually don't like using up more than 10% of my available margin. So if I've got, for argument's sake, £10,000 in an account, I want to keep free equity of 9,000. And you might think, why? Well, because I want to make sure I'm not using up too much leverage. Why? Well, because if the market moves against me, I hate getting margin calls. Okay, but that's a separate issue. That's with spread bets and CFDs. Here, we're just talking about the underlying stocks and the exchange traded products and the leverage parts of those. Okay, so hopefully that was all helpful to you.